Hey guys, welcome back to the channel. In this video, I'd like to walk you through how to start a dividend ETF portfolio. We're going to talk about the pros, we're going to talk about the cons. So by the end of this video, you're going to have an actually funded dividend ETF portfolio, at least enough to get you started, and you can grow it from there. So grab a cup of coffee and let's get right into it. So let's talk about one of the pros about investing in a dividend ETF portfolio. The first one is the reduced risk and volatility. Whenever you make a single stock purchase, something like Google or Tesla or Amazon, you'll see that it has a lot more swings, meaning that on any given day, it could be up 10%, on the following day, it's down 10%. That essentially is the definition of volatility, where you don't see a very congruent trend going up or down, but that the stock is up or down on any given day. When you're investing in dividend ETFs, you don't get that volatility. You don't get as much up and down swings. Now, although dividend paying ETFs do grow, they grow at a much slower pace than individual stocks and growth stocks, which is why they're a lot less risky and a lot less volatile. And during bear markets, or when the stock market is not performing well, and a lot of the tech stocks, bigger growth stocks like, again, Amazon and Google, have been losing a lot of value. Whenever you're invested in a dividend ETF portfolio, you're actually, because you're not going to see as huge growth, you're definitely not going to see as big of a fall as well. A lot of the investors that buy into dividend ETFs, they're long-term investors, so they're not going to, liquidate or sell all of their stocks because of a news headline or a market cycle. So although you're going to see a lot less highs, you're going to see a lot less lows, and that is a huge pro, especially when you're just getting started. The second pro is passive income. So I would argue that investing in a dividend-paying ETF is probably the most passive income of all passive incomes, because all you have to do is you put up your money, and once a quarter, you're going to get a dividend for not doing anything, just allowing them to hold your capital. Even if you don't want to wait for quarterly dividends, there are companies that are actually paying monthly dividends as well. So you just have to pick on what works best for you and suits your needs better. One of the biggest pros about investing in dividends or dividend ETF is the tax advantage. The way that IRS looks at dividend income is much different than it looks at ordinary income. Ordinary income is where you're typically taxed the highest amount. So for instance, if your ordinary tax bracket, you fall in the 30%, let's say. Well, on a dividend side, you would probably be anywhere around 12 to 15%. And then if you are earning a little less and you fall in the 10 to 15% tax bracket for ordinary income, then your dividend income actually isn't taxed at all. So it's like the IRS is saying, hey, here's some free money on your gains. So you should definitely be taking advantage of this. All right, so number 4, compounding returns. So the crazy thing about investing in dividend stocks or dividend ETFs is that whenever you get a dividend and you reinvest that dividend, essentially you're buying more stock. So the next time you get a dividend, it's actually going to be greater than the previous time you got it because you invested that dividend. And then this continues to happen every quarter, every year, and this continues to compound over a long period of time. If you take a look at this chart that's on screen now, you'll see that there is a phenomenal difference between just investing the same amount month over month versus investing that dividend every month and then letting it compound over many years. So let's hop into some of the cons. One of the biggest cons is that no company is obligated to continue giving you dividends. At any moment, they can pull the rug and say, we're not going to be issuing a dividend anymore. Companies are legally allowed to either pause dividend returns temporarily or even cut them altogether if they're not earning enough profits or enough revenue to pay out dividends to its shareholders. Most recently, one of the greatest examples of this is Disney, who for many, many decades was known for increasing the dividends they were paying their shareholders, except in 2020, because of the pandemic strain on their business, the parks being shut down, etc., they actually stopped paying dividends. And this is a huge con because the only reason most dividend investors invest in a specific company is to get the dividend. Another con is that dividend stocks don't experience massive growth like individual stocks or growth stocks. So companies like Shopify, like Google, they'll experience tremendous growth over years. And one of the reasons is because these companies are, instead of paying a dividend to their shareholders, they're taking all of the available resources, including the revenue, and instead of giving it to the shareholders or sharing it with the shareholders, they're actually reinvesting it into the company to create that accelerated growth. So if one of your investing strategies is to get accelerated growth, this is probably not the way for you to do it, because these companies are going to grow at a much slower rate. These are companies like Coke, Johnson & Johnson, that they're behemoths in the market. There is not a ton more market share that they can acquire, so they're able to pay out a dividend to its shareholders. The final con is just a lack of diversification, not across different industries or sectors, but on a company size. The companies that tend to pay dividends tend to be large cap companies. And generally speaking, a well-diversified portfolio would include some small caps, medium caps, and large cap businesses. And cap just means a market capitalization. A large cap company is a company whose market cap is above $10 billion. So these massive companies actually have money where they can actually give it to their shareholders, because they don't need to grow as rapidly, because they already have so much market share. Companies like Coke and Johnson & Johnson, like we mentioned, they're able to reward their shareholders, and they're rewarding you with the dividend because the stock is not going to grow as quickly, because it may have already reached a fairly high point. All right, so enough with the pros and cons and the boring stuff. Let's actually open our brokerage accounts and invest some money. All right, guys, so let's jump right in. One of the brokerages that I use is Robinhood, which is super common. And I actually do have Fidelity as well. I've tried Vanguard in the past. This was a couple years ago. The problem with using one of these like traditional brokerages like Vanguard or Fidelity is the UI is super clunky, to be honest. You have more modern ones like Robinhood or like Webull. In this video, for demonstration purposes, I'm actually gonna set up my account with M1 Finance for two reasons. One, I've always liked their platform, the way that they present themselves, on social media, and the way the website looks. To be honest, it's aesthetically pleasing. And then the other reason is they have a credit card option that I've always wanted to try out. So I'm gonna set up this account, and you can use any of these brokerages. All of them will allow us to trade ETFs and allow you to build a dividend portfolio. You need to pick whatever one is best for you and for your use case. All right, guys, so I'm here on M1 Finance. If you are on your mobile device, obviously it looks like they have a beautiful app. So just search it in your Google Play or Apple Store, download the app. I am going to hit get started. And I'm gonna type in my email and create a password. Boom. So this is cool. They're offering 1 year of free M1 Plus, which includes some additional cash back. You can borrow some money, and then you have a later trade window. This is pretty cool. So what does this mean? Renewal 3. I'm gonna hit skip for now. Actually, it includes the credit card. So let's go ahead and do that. Membership process. I'm gonna confirm my email here on my second window. In the meantime, it's walking me through the platform. So there's some auto investing stuff. This is pretty cool. It does auto rebalancing. I actually thought this was pretty interesting. So essentially, if a part of your portfolio gets overweight, so for instance, you have a lot of individual stocks and you don't want to, once you reach a certain threshold, it'll actually like place some sell orders for you. There's good and bad about that, and we could probably create an entire different video about that, because for instance, if you didn't hold that stock for a full year, you're going to get taxed a lot higher. So there's a lot of pros and cons. Me personally, I'm gonna leave mine off for the time being, and then we can jump into that way later on. So let's continue. I get it, I'm in control. I can buy and sell, great. Rebalance with one click, that's great. So it wants to verify my identity. I'll put in my cell phone number. And now let's look at the confirmation code. Got it. And I'm gonna fill this out as you should. Do not be hesitant to fill this out. Any brokerage is going to ask you all of the same information here. And it's actually gonna ask me a lot more probably on the next page. So let's fill this out. Okay, so it looks like I just filled out all the personal information. It included things like my birthday, occupation, social security number, of course, so that they can do a credit check and a background check. And then I also did stuff like what's my salary, what's my net worth. They want to know essentially if you're an accredited investor or a retail investor. Again, this is all normal, so I don't want you to feel like you're being pressured to give information and someone's going to steal your identity. That's not the case. They need this information from you before you can open your account. So now it's asking me if I want to add a trusted contact, and I'm going to put my wife in here. Just, worst case, I pass away, she has access to the $100 we're going to invest today and whatever else we invest in the future. Okay, so I'm gonna link my bank account, we'll fund this thing, and then we'll buy some ETFs. All right, so I was able to link my accounts, we're going to fund, and now we're gonna select some ETFs. So just like I mentioned in this video, we are going to be doing $100. I'm gonna confirm the deposit. And boom, funds are on its way. So let's go to continue, choose securities. All right, so let's go right in here. This is a pretty cool dashboard. I'm just gonna point that out. It's probably one of the best ones I've ever seen. It's better than Robinhood, that's for sure. So I'm actually gonna go into another website that I like to do research on instead of this one. Let me show you what that looks like. So this is a website called ETF or database.com. And you see that they have over 2,500 ETFs here. When you get to the website, what you want to do is you want to go to ETF screener, and you'll see this is going to show up here on the top. I'm going to go into dividends, and SPY is actually something I'm heavily interested in, but I'm already super invested in them in my Robinhood account, so I don't want to buy this one this time around. One of the cool features here is that you can obviously organize all of these different ETFs based on stuff like the frequency that they pay, the date of the last or the next one, and of course, the annual dividend yield. This is how much on your money they're going to pay you back as a dividend. So you can essentially go here and see that there are a lot of very high dividend paying yields here. One thing to keep in mind is that there's certain things as like a dividend trap where a company has really poor fundamentals. And one of the things that they want to do is entice early investors or newbie investors into thinking that this is a phenomenal company. And as you're getting paid this dividend, they could easily cut it or stop the dividend. And at the same time, their valuation is crashing. So you definitely don't want to fall for that. You want a company that's paying you dividends, but at the same time is solid fundamentally. So again, companies like I mentioned before, which include Johnson & Johnson, Coke, and actually Apple happens to pay dividends as well. So I want to find a company here that is going to pay me a somewhat very good dividend yield, but at the same time is a sound company. I've already done my research ahead of time, so we don't need to do that here. I just want to find the one that I am looking for. Just to give you an example too, there are a lot of ETFs that include different things. Like for instance, let's just pick a random one here. Here's a treasury bill. So if you want to invest in like treasury bills, this is one way to do it. If you want to invest in private equity, this is one way to do it. If you want to invest in a high income ETF or a dynamic commodity, commodities are things like oil and gold, silver, etc. So you can diversify your portfolio, still get dividends, and at the same time, not only be in large cap stocks. So I don't see the one I want to invest in here on the list. What I want to do is I want to search for it. So one of the ones I've been thinking about investing in is Schwab US Dividend Equity. One of the reasons I decided to invest in them is because they've actually had about a 16% return over the past 5 years, and they rank very highly in this category. So what I'm going to do is I'm going to go back to M1 Finance, and I am going to find a way to search for these guys. Here it is. And I don't have anything that is Schwab. So one of the other ways I like to diversify is the company that I'm buying. I want to make sure that I don't have a bunch of just Vanguard or just Fidelity, but that I am diversifying. So here, I'm gonna add to the basket, I guess. Add, look at, the first time I'm doing this with M1 Finance, guys. So just letting you know, portfolio name, new portfolio. Sure. Buy, save. So I don't want to do
auto invest for now. Oh, that's interesting. So I can essentially put in multiple different ETFs here. And then when I hit buy, it'll buy a little portion of each one of those ETFs. That's amazing. That makes it so much easier to trade. So I have $100. Let's put in the entire $100 in there. Continue. It's going to execute at 3 p.m. today. And the order has been submitted. So again, I don't own it yet because it said the order is only going to be placed at 3 p.m. I don't actually understand why they don't actually place the order on the spot. So that's interesting. Yeah, I didn't know, because essentially you can miss out on a ton of opportunities if it's that delayed. But okay, interesting. All right guys, so that's the end of this video. The purpose of this is just to show you that investing doesn't have to be hard. It doesn't have to be complicated. You can start with very little. If you want to invest $10, you can. If you want to invest $100,000, you can. I am going to keep up with this portfolio, and I'll post videos about it and updates about it. If you like more consistent updates, check out my Instagram account. I post on my stories all the time. And that's it, guys. Thank you for watching. Enjoy the rest of your day. I'll see you in the next video.